Hey everybody, I know bumpy day in the markets, but we're going to chat about exactly what's going on and what we believe are the three causes for this sell-off. But don't worry, we have hopefully a little bit of good news as well as we go through. So let's jump in and not waste any more time. Brought to you by whatever beverage is in my container. I don't even know. Anyway, let's jump in. First of all, thank you all for being here. Thank you to the mods for being here too. You know what the channel's about. And disclaimer, none of this is investment advice, although I did do some nibbling today and yesterday, so why not? So first of all, the three reasons for the crash we believe, we'll dig into them in detail. First, miners started selling at 42k. Second, cascading liquidations, the most since February 24th. We'll talk about that too and why that's a critical day. Third is a lot of fear of the inverted yield curve. Boo. And CPI news out tomorrow morning, 8:30 a.m. Eastern time, etc., etc. We'll see exactly what happens. But again, I have a funny feeling it'll be exactly what transpired before. Buy the rumor, sell the news, etc., and vice versa. So basically, what the markets are doing now is they are anticipating really bad news when it comes out to what people expect, where the price is, where everything's already priced in, like 50 basis point hike, etc. Again, it's usual crazy market stuff, but take advantage. Stack a little bit where you can. Now, first of all, we're going to look at the market and Bitcoin because that's driving a lot of stuff. We're also going to talk about equities and the stock markets and everything else in general. But one of the things I always leave these lines on, we did break through that ascending line, the green line at the bottom. I have two blue arrows there signifying where we broke through this support. Typically when this happens, this is one of the positives I'm trying to highlight. Not slinging hopium, but we did this back on Feb 24th, and it was very short-lived. It shot through it and bounced right back up, and then it was acting as pretty good support. So depending on whether you're looking at a 5-minute, 1 hour, 4 hour, 1 day candle, it might tell a very different story. Right now, the market is beginning to bounce a little bit. Let's have a quick look and find out what's going on in the market itself. If we pull up the chart, well, now no point in really showing you, but you can see that Bitcoin took a little bounce off that little bottom at around 39.2, shot up to nearly 40k and sold off again. So we don't know where we're going to go from here, but odds are if we do go down somewhere, it'll probably be worst case, no guarantees, but 37k, 38k, but odds are we could rally higher real fast as we go forward. So let's jump into a couple more aspects. First of all, number one reason, Bitcoins are mining their stash. This is an article that was in, I think, Decrypt today, and on-chain data suggests miners were behind the sell-off. Weird theory. Sometimes things happen in combination. So let's look at the chart, the on-chain data from CryptoQuant. Here you can see in the graph right now, I put in two gray arrows showing the significant outflow. We did have one again back in early March, and it was followed immediately by a price drop off, a sell off, very similar to the size of sell off now, even though the outflow from miners was a lot less. And these miners are desperate to raise cash to buy rigs so they can mine more Bitcoin. And that's the whole end game here. Sometimes they have to sacrifice what they would otherwise hodl on their balance sheet just to get more Bitcoin. By the way, let me know in the comments if this got a little bit louder. I just turned up the volume a bit. Somebody said yesterday it was too low. I don't know, this thing. Who knows? So next thing as well to look at is look at what the miners are doing, just because we're on the topic of miners. And a big thank you to Sanjay, who sent this to me. The Core Scientific Mining group is absolutely exploding, not only in terms of hash rate. I think they had about 13 exahash at the end of 2021, and they are planning to have about 40 to 42 exahash at the end of 2022, with about 1,300 megawatts of power. And that is staggering. But look at the amount that they mined in Q1. Well, basically between December 21st, December 2021 and February 2023, a 3-month period, over 3,000 Bitcoin. That is 2.4 times more than the next largest publicly traded miner, which is Riot at 1319, Marathon 1307, Hut 8 873. So if you look at the relative market caps, so one of the things we look at is the amount mined based on market cap proving capital efficiency, and Hut 8 still scores very well. But Core Scientific is really, really growing, and we'll be coming up with an updated mining video real soon for those miner fans out there. Now, next, let's look at the cascading liquidations. This is reason number 2. If you look at the the green bar for the longs that were liquidated for Bitcoin, basically in the last 24 hours, you can see that matches the height of the bar on the 24th of Feb, which again is not a coincidence. You may remember the key days for me were 24th of January. That's when I got into the big synthetic long with MicroStrategy, when MicroStrategy was at under 330. And then February 23rd was when the tanks unfortunately rolled into Ukraine. And February 24th, when the markets opened, that's when I deployed the rest. But that cascading level is exactly on parallel. It shows you what we went through is pretty significant. Now let's talk about the third reason real quick. This is the fear of the yield curve. Everybody's talking about the inverted yield curve, probably till they're sick or blue in the face, but I keep getting questions. So here we are. It's typically when the 2 and 10 year are compared to each other. This is the spread of all the yields for all the different durations. And you can see the 2 year was at, on the 1st of April, 2.44, and the 10 year is at 2.39. So typically, short-term bond yields should be less than the long-term bond yields. And if they're not, things are broken. But let's dig into this a little bit more, because there's a little bit more to the story, why people are so concerned. I won't dwell much on this, so bear with me. If you look at the typical history of inversion, there was a big inversion before the dot-com bubble. Boom, followed by a nasty recession that lasted nearly a year and a half. Second time was the inversion before the great financial crisis, which was a really bad situation. It was nearly 2 years of miserable times for people, real estate, markets, etc. Then we had the inversion in approximately December 2019. And 4 months after that, we had the C19 crash. But that is kind of a different situation. It's not really a financial crisis per se, it's more of a black swan that anybody who picked up any medical journal would have known about it. And now we have the inversion now. But there is a little bit of good news. Now, people do freak out because they do think when the yield curve inverts, it precedes a recession. And that makes everybody nervous. So I think there's just a truckload of nervousness out there. But if you look at the yield curve today, you'll see it's kind of flipped back to being normal. So this is where the 10-year is now at a higher interest rate than the 2-year. The 2-year is the orange line that I drew on the chart, and the 10-year is the green line. So hopefully we're back to normal. Hopefully things will reel in. But there's another problem we need to be aware of, and that is this. This is the inflation expectation tomorrow, 8:30 a.m. Eastern Time, 5:30 my time. I will be awake, don't worry. And the data comes a day before what the market expects to be about 8.4% increase in inflation over the last 12 months. Remember, this is very much a cooked number. But if it is accurate, again, that'll be the highest since early 1980 timeframe, thereabouts. Now let's look at what is happening with the CPI and how people are just ratcheting up the CPI expectations. This is from Bloomberg. Again, the long-lasting CPI expectations. February survey was X%, the orange box, then the March survey, the white box, and the April survey, the blue box. You can see it just goes up and up and up. And then you get people at the Fed saying, oh, we expect inflation to be above 2% next year. It's like, anyway, if you follow me on Twitter, you'll see I was like, big face palm. Anyway, this is the issue we have to look at. Now, this is what the market expects. This is what the Fed are planning to do. And when you look at the actual numbers, it's not that horrific. Okay, so this is the Fed's dot plot. Now, they plan to be at, it's a bit of an eye chart, so I apologize for that. But if you look at the years, you got 2022 at the bottom, 2023, 24, and longer term. You can see longer term, they expect rates to go back down low. But in the interim, they expect, the way you read this, approximately about 1.9% by year-end 2022 this year, and 2.8% by year-end 2023. So we are going up. But remember, these are still historically very, very low rates. And as far as I'm concerned, we are about to face incredibly bad supply chain problems. Shanghai is completely locked down, factories are shut, etc. Hoping it doesn't hit the Tesla factories in Beijing again. So fingers crossed. But we haven't seen anything yet around inflation. Things like commodity inflation, food inflation, wage inflation, energy inflation, they are all going to be further exacerbated by supply chain problems from lockdowns in China. And we'll see what happens now. The question is what the Fed have to do, and their problem is, can they walk the fine line? It's an election year coming up to November. Can they jack up the rates just enough so they don't implode the housing market, which would tank the construction industry, which is a major employer in this country, and probably around the world as well? And also, can they cool down the labor demand without causing a lot of unemployment, etc.? Now, many people believe there will be a recession in 2023. Good news. I think that was the senior strategist at Rabobank in the Netherlands believes that's possible. So we have time. So everybody, this is a short-term headache, short-term volatility. The world is not ending. And this is human nature. People tend to completely over-panic in these situations. Yes, the markets are down, but let's compare Bitcoin to the tech market, the Nasdaq QQQ correlation. This is the last 3 months, the last 90 days, whatever you want to call it. You can see here, for what it's worth, and I know many of you are feeling the pain, say, oh, Bitcoin is down, it's terrible. But the Nasdaq is down a lot more. So Bitcoin over the last 90 days is up 10%, and the Nasdaq is down 6%. So again, once you zoom out and get that perspective, things aren't all that bad. And Bitcoin is holding up as a very solid, against all the other major asset classes, it's doing quite well. So let's talk about some stocks, and then we get into some crypto, mixing up the order here, because all these things are important to us. And these are technically crypto-related stocks, all disruptive stuff. Now, Cathie Wood, at last, dumped her PayPal for Square today. And she favors the Bitcoin Cash App. If you've been following me, maybe she's following me too. I was on the exact same page. I do believe the type of work that Jack Dorsey's doing, his dedication to Square, the work they're doing with Lightning, the work they're doing with Square Cash App, and PayPal, and crypto, and mining, and partnering with Tesla. I mean, the list goes on and on. So much. But Cathie Wood discovered Cash App makes more than twice the revenue from half of the number of Venmo's customers. So think about that. They're 4x more effective and efficient in generating revenue from the customer base. And Cathie Wood, I think, just got rid of it all. So that explains as well some of the weakness with PayPal. For the longest time, the stock price of PayPal was higher than Square, and I was always like, why is that? I always look at kind of pairs and try to figure out, why is one valued more than the other? It doesn't make sense. Now, the market is pricing things correctly, which is good. So next in the box, it's splitting season, not splitting headaches, splitting season for stonks. The Shopify is the latest to announce a 10-for-1 stock split. And this is incredible. Not only that, Shopify had that big announcement at the Bitcoin conference, which also helped it. I do own a little bit of Shopify. I need to own more. I want to get more. And because I do love pre-split runs. Now we have Google and Amazon doing 24-1 stock split. We have Tesla announced they will split. They didn't say when or how much, but probably a 5-for-1, I'd say. Last time I think they did a 4-for-1. And now Shopify is jumping into the fray with a 10-for-1. Extremely exciting times. And all these companies, with the exception of Google and Amazon, of course, are quasi proxies to crypto as well. So important to watch. And as you guys know, I like to play both sides of the fence. So let's talk a bit about crypto now. Proof of stake test merge success. This is the Ethereum's first mainnet shadow fork goes live. That's a positive. They did conduct their first ever stress test on the Ethereum mainnet. They call it a shadow fork. Sounds a bit shadowy and scary, but it is a big deal because it does require interaction with the Beacon main chain infrastructure, which is critical for the merge. And technically, the shadow fork is running in parallel with the mainnet. In fact, they're looking to launch what used to be called Ethereum 2.0. I know they got rid of that name now, moniker, but the merge is supposed to still be planned for, some people say late June, early July. Some people saying even May. I think July is probably a fair stake. That's what it looked like. Nice purple colors. But the good news today is you do have validators who work on the proof of work chain and on the proof of stake chain processing transactions. And we'll see where it all goes. But hopefully it'll be bullish for the crypto market and for Ethereum as we go forward, despite all the headaches. Now, another big one. As you know, we like Luna here. We didn't like the Avalanche buy, but that's a separate issue. I still own a little Avalanche, but I don't think it's a pristine collateral to back a stablecoin. But what is very big here, if you read this headline, stablecoin economy is now 10 billion away from reaching a $200 billion market cap. That is 10% of the total crypto market cap. Stablecoins are bonkers. They are a huge part of this whole world that we are now in, and it's only just begun. They're growing in leaps and bounds. I think Tether is still the largest. They've grown by about 3% over the last 30 days. Like 3% of it's over 82 billion, I think, is a big chunk. And then you have second is USDC, which is good. They actually declined a little bit over the last 30 days. I think USB, the Binance coin, I think is third place. I don't remember how big they are, but coming up fast from behind is UST, and they're at about 16 or 17 billion, growing very fast, faster than probably anybody. They might actually be eating market share away from USDC. We're not sure. We'll see. Now, let's talk about this. The spot ETF, the catalyst that we know would blow up this market completely. So a new Nasdaq survey, I think this has been floating around. A lot of people have been talking about this. 72% of certified financial advisors would invest more in crypto if a spot ETF were available. That is bonkers. And they said the allocation would be up to 6%, I think was the actual number. So these people represent trillions of dollars. And imagine if they say to their customers, hey, stick 6% into Bitcoin. Wow. it would be crazy. Now, they had another aspect to the survey where they said, well, what percentage of advisors do you believe will have a spot ETF in 2022? I think it was around 38% that believed that would happen too. So that is overall positive. I was still hopeful for June, July timeframe for a Bitcoin spot ETF to be approved, but we'll see. Now, there is another little bit of bad news that we need to make you all aware of. And not because we care, but we care about the markets. And this does impact the markets. C19 is on the rise again. China lockdowns are absolutely horrific with their zero COVID policy. And Philadelphia has brought on a mask mandate again for the first time in a while. So full and partial lockdowns in the past month have affected, I think, 23 cities in China, accounting for 200 million residents. And that's worth about 3.6 trillion of GDP, basically 22% of the world's economy. And it's on the rise. I'm not sure why. All these people are heavily vaccinated. And I think the problem is they don't have that herd immunity. And the Omicron variant is extremely contagious, just like the measles. And other news as well, the World Bank has slashed China growth forecast for 2022, sharply down to about 5% from over 8%, all due to a combination of factors. You know, another series of perfect storm. You've got supply chain problems, you've got lockdowns, you have Ukraine, you name it, everything's hitting at once. So this is going to have an impact on the macro. It's going to have an impact on inflation. It's going to have an impact on the markets. So buckle in. But remember, there's a lot of money out there that still needs to find a home. Now, being concerned about, hope you like the show. I'll see you tomorrow. Tomorrow is going to be Okta, which is On-Chain Technical Analysis Day. We're going to look at all the numbers and stuff and charts and data and see what we can come up with and see if there is a ray of sunshine. We are still under 39,800, but again, all the markets are getting hit hard, not just Bitcoin. So big thank you, everybody. Hope you have a good night. Thank you, the mods, and I'll see you all tomorrow. Bye.